Gurmeet, can you tell our viewers a little about power of compounding? I mean, it's called the eighth wonder, and it builds wealth, and the richest people in the world seem to have used it to their advantage.
Correct.
How does it work for investors? If you could explain power of compounding.
So, as I said, optically, when you do a fixed deposit at 7% and you're expecting 10% returns in equity with volatility, you see what's in it for 3%. But if you were being, let's say, for example, investing, and let's take a hypothetical number, and if you're, let's say, investing let's say 1 lakh rupees a month, I'm just taking a number more for making calculations simpler, at 7%, you would possibly take about 16 to 18 years to make 1 CR. At 7% growth. At 10%, you probably will end up doing about 3 CR in about 12 to 13 years in the same time period. So 1 lakh rupees a month at 7%, 1 lakh rupees a month at 10-11%, the difference after 12 to 15 years could be 2 to 4 times, and it just keeps, adding up. Add to that the tax efficiency part, which equities bring in. So, we typically say, and this rule we used to use when our nominal growths were 14-15%, is 15-15-15, which is 15,000 a month for 15 years at 15% becomes a crore. So we used to follow that as obviously now though the math equation will change because now we are talking more 10-11%. So over long periods of 20-30 years, a similar amount, the difference in your final corpus could be 3 to 5x, even with a difference of 3 to 4%. So it's extremely important, you start and don't break that compounding in between. In fact, these are the times to, in Western countries, we call it a step-up SIP, and there's something called value averaging in SIP, where you have a higher, installment of SIP going when certain valuation parameters are low. And play it over a long, because the end part is which creates a bigger difference. So
time.
Yeah, so let's say at 10 lakhs at 10% will become 20 in 7 years with rule of 72, right? So 10 becomes 20 in 7, 40 in 14 years, and 80 in 21 years, right? And 160 in 28 years. Now you do that on a 6-7% gain, 10 becomes 20 in 10 years, right? 40 in 20 years, and maybe 80 in 30 years. So in 30 years, an equity investment of 10 lakhs, is 3 times the fixed income investment over a long period. So as time horizon keeps going up, the compounding keeps, and we heard so many stories of, so index is 320 times since inception, considering today, the correction we have seen in last 20%.
320 times.
So yeah, so 320 times. 100 was the base for Sensex in 1979. You are at 32, 33, you are in that range currently with fluctuations of 2,000, 3,000 points. You are talking of 30x, and that 30x is 11% growth with 1.5% dividend yield for the benchmark. So 30x looks very high, but over a 30-year period it works out to around 10 to 11%. Look at a lot of mutual funds. The NAVs are in excess of 500. I know at least 10 such schemes where the NAV is more than 500. That's a 50x return, and the mutual funds go back to 90s. So if you take 20-25 years, the funds have delivered about, again, the return, if you put pen to paper, would be between 13 to 15% over a long period. So that's how it can make I don't see any other asset class doing that. Maybe real estate comes a little closer, provided you are you have those kind of resources, and equity doesn't require those kind of resources or skills. And you can start, you can't buy real estate with small amount monthly. You can do that with equity.
Pleasure talking to you, Gurmeet. Thank you very much for joining us here. Thank you.